All right. Well, welcome everybody. We're super excited to have you guys here, whether you're listening to this live or recorded later. We're thrilled to be able to share with you guys about Gibson Capital. Today is our first new investor education webinar, so we're thrilled and excited to share this with you. Before we jump in, I just wanted to share a disclaimer. Anything that's talked about today, any of the content is purely informational, and any of the information shared, conveyed in this presentation is not intended to constitute any legal, tax, accounting, or investment advice. So any ideas or strategies that we've discussed, make sure to consult your financial professional or conduct your own independent research. So that last point is actually one of the beauties of real estate syndication investing, doing your own research, and we'll get into that in a second. But our agenda for today is who we are, who is Gibson Capital, what do we do, what is real estate syndication investing, how does it work? Chris is going to take us through how do we evaluate real estate deals, and then we'll have some time for Q&A. So we've got about 20 minutes or so of slides, and then we'll have probably 10 to 15 minutes of Q&A. So who we are, for those of you guys who don't know or are watching on this recording, my name's Kurt Gibson. Me and my younger brother, Chris Gibson, are the co-owners of Gibson Capital. A little bit about our financial background in real estate. Chris has been long-term investing in primarily equity since 2011. He owns and operates his own investment management company since 2020. And my background in real estate began in 2016 when I bought my first property. And since then, I've grown to own 8 single-family / condo townhomes that I self-manage myself. So, and both of us have begun investing in multifamily real estate syndications since 2022. And so we've had success with them. We've really enjoyed the experience. And that is why we decided to start Gibson Capital, to share this with our network. So what is Gibson Capital? Well, our mission is to help busy professionals like yourself obtain financial freedom through passive real estate investment opportunities. So what is a passive investment real estate opportunity? So there's 4 asset classes that we will be focused against and we will be sharing deals with at Gibson Capital. So number 1 is large multifamily. So this is a very basic human need. The demand will never go away within this asset class. So think the 100-unit apartment buildings and up. And, you know, people have talked about a looming recession, what might happen in the future. There's some uncertainty. Well, if anything, people will look to downsize. Maybe they can't, live in their home, or, they want to look to live somewhere cheaper. That's where apartment complexes come into play. The second asset class is short-term rentals. So I'm sure all of you have stayed in an Airbnb or a VRBO before. Within this short-term rental space, the demand is surging. And especially since COVID, there's been a big shift to rural, outdoorsy type activities and rural areas of the US, whether that's the Poconos, the Rockies, different parts of Georgia, and even rural parts of Florida. There's different pockets all over the US that are just growing. And this space is very, very interesting, especially since there is a lack of institutional competition. So think the big hedge funds, they don't really play in this, and it's kind of hard to scale up, which is a big reason why. So number 3 is self-storage facilities. This is pretty self-explanatory. It's a very simple business model. Essentially recession resistant, as people look to downsize, may look to cut down on living space and live more frugally. They put their stuff in storage at a cheap rate. So this can achieve high levels of automation and have low labor, and so therefore can have some very good cash flows. And then lastly, RV campgrounds and mobile home communities. This is very affordable housing when compared to the rest of the market. small rent increases can equal large percentage gains within it. So it's a nice asset to own and have a share of equity in, and definitely rounds out the last of the 4 asset classes that we'll be focused against. So what is real estate syndication? So its basic definition is that it's a partnership between multiple property investors and a sponsor to fund a specific development project. So syndication's kind of a fancy word for group investing. So, and I use this example here just to kind of help kind of wrap your head around this idea of group investing and why it's necessary. So the median home price in the US as of last month was $382,000. And for a normal middle-class American to buy one of those at 20% down, which is to avoid any points, throw in the fees, you're looking at close to $100,000, depending on how much you put down, which is quite a bit of money for any average American, middle-class American. And so when you look at the multifamily space, the deals are much, much larger. And so the ability for just one investor is extremely, extremely difficult. You have to have a huge amount of capital to be able to invest in this on your own. So hence real estate syndication and group investing. And so when you look at this example of a $10 million multifamily asset with 100 units, putting 30% down would equal $3 million. This image on the left just gives you an idea of multiple people pooling their money together to be able to own a share of that asset. So that is at a high level what real estate syndication is. So how does it work? So Gibson Capital, what we would do is, if you've perhaps signed up on our investor club, if you're watching this on replay, if you haven't signed up for our investor club, please go ahead and sign up if you want to hear about the new investment opportunities that we have. And basically, between Chris and I, will identify a top tier investment and share it with you. And the difference between this and any other type of investment vehicle, whether it's a private equity fund, a REIT, a real estate investment trust, or some other type of just, financial investment, is that you generally give your money to somebody else, a management firm, a private equity firm, and they make all the decisions on behalf of you. In this situation, you are the one that evaluates the deals, and you are the one that says, I want to invest in that deal. I want to invest in this deal. So as we send things out, the example of you receive an email in our investor club and you say, you know what, I'm not interested, delete, right? Maybe the next month or a couple of weeks later, there's another one that comes by. You say, oh, I'm not interested, not for me. Maybe the next one comes by and you say, ooh, this is interesting. I want to invest in this space. This looks like a deal that I would like to participate in. So you vet it. You vet what's the market location, what's the asset class, and who is the sponsor. And Chris is going to go through some of that of what we do to vet some of those deals here in a minute. But then you'd submit a soft commitment saying you're interested in investing. You'd go through the whole process of signing subscription documents, funding the investment, and then receiving distributions, which typically, obviously it's real estate. There's cash flow, could be monthly, could be quarterly. It's all dependent on the deal. So before I turn it over to Chris, the last thing I'd kind of just get your mind to try to wrap your head around is, the bigger the pool of money, you can get into different you can get better terms and better returns on your investment. So if you're just somebody that wants to invest $25,000 in a giant, apartment complex worth $50 million, your return's not going to be great because you're just a small player. But if you're pooling your money together in this real estate syndication world, then you can get better terms throughout the length of the deal. And then once you get your capital returned to you and any additional equity that you earned during that investment. So with that, I'm going to turn it over to Chris and show how Gibson Capital evaluates deals.
Awesome. Thank you, Kurt. Hi, everyone. So again, my name is Chris Gibson. And like Kurt mentioned, in the step-by-step process on actually logistically getting invested in these types of deals on the last slide, the thing I want to point out is that the most important thing is that you're going to need to do is evaluate the deal to see if it's a good fit for you, right? So we at Gibson Capital, we are going to be pre-vetting all the deals that we bring to our investor club, but each and every investor has different goals, right? And is at different stages of life. So it's ultimately going to be up to you to decide if it's a good fit for you. So what we see here is this is a sample deal package, at least the front cover of it. And so as we talk about further how we're going to evaluate a deal, this is the first image you're going to see when a particular deal comes to your plate through our investor club. It's just going to have a nice picture of the property, and it's going to give some highlights of where it is and how many units right there on the front cover. So what we're going to talk about next is I want to review. There's a lot of things that can be analyzed when looking at a real estate syndication deal. But what we want to do is relay to you guys our top 3 things that we look for in a particular deal, so that the first time you get one of these deals, you can apply the things that we talk about today to decide if it's something that is good for you as well. So these top 3 things are: number 1, the business plan of the deal, along with the financials that go along with it. Number 2, the market and the location of the deal. And number 3, very importantly, the sponsor team that is operating the deal. So let's take a deeper dive into these 3 things. So the first thing we talked about, the business plan. So the first thing we want to do is read that business plan, because what that does is it answers, why did this operating team buy this property in the first place? Why did they buy it? And what do they plan to do with it to make it more valuable? So questions that we want to be asking ourselves after we read, or while we're reading the business plan and try to answer, are: number 1, do the numbers make sense that we're looking at in this plan? And number 2, is it truly underwritten conservatively? And what I mean by that is, it doesn't take a lot of analysis. We've all lived at apartment complexes and done, various business transactions where if this team thinks that just by updating some signage out front and maybe throwing in a new dog park is going to equate to $300 or more, per unit, then that's something that maybe you might disagree with and question whether, that's going to bring in the revenue, the projected revenue that they're calculating, right? So the number 1 thing that I would say that when you look at the business plan and the financials in a deal is you want to look at the projected rent comps. All right, this is probably the single quickest and easiest thing that you can check to confirm whether the operating team that's bringing this deal is overly optimistic about their business plan and whether they're underwriting too aggressively. So as we look on the screen here, we see a sample of a short, compact business plan, and then we see the rental comps to the left. So in this particular sample deal, the business plan relayed by the operators is the plan is it centers around renovating 100% of the interiors of the property. Number 2, they say there's significant loss to lease of the property, which simply means the current apartment units, as they currently are currently going for under market rent. So there's a lot of opportunity without even doing renovations yet that they believe they could simply bring those units in line with market rent that the previous owner was not doing to capture additional revenues. And then lastly, they say they can increase other income by implementing other strategies such as RUBS and reimbursement fees. And what they're relaying here is that apartment buildings have different models for how they either charge or don't charge their tenants for various utilities. RUBS and reimbursement fees are just different models to capture some of that revenue so that the owners of the property aren't coming out of pocket too much themselves and just passing that cost on to the tenants of the deal. I mentioned the rental comps as being the primary thing that you can probably look at after assessing the business plan of seeing, does this make sense, their projections. So as we look at this particular example, the deal that we are particularly looking at in this example is highlighted in red. So at the very top, we have a handful of comps, comparables around the neighborhood of similar deal size, built in the same neighborhood and built around the same year. And in proximity to each other. And then below that, we see what the current going rent is at those properties for 1 bedrooms, 2 bedrooms, 1 bath, and 2 bedroom, 2 baths, which is basically the unit mix that this property we're looking at has. And what this image is telling me is that the operators or sponsors of this deal are saying after they perform all of their renovations, they project the numbers highlighted in red, which you see the numbers in blue relative to comps. They're not being overly aggressive. They're not being overly optimistic. They're saying, we believe by implementing our value add plan that we should get somewhere near underneath average, right, of market rent when all is said and done. So that's the kind of stuff we're looking for in a business plan and the financials. The next thing in our top three things that we want to look at is the market and the location. So when we look at the market and location, we want to look at three specific things here. Number one, is the market growing in population? Number two, does it offer job diversity? And number three, is this specific location in the city desirable? Right? So looking at, is the market growing in population? We want to know, not only is it growing, but will that trend continue? So from basic econ class, we know about the supply and demand curve. And so we know that more bodies in a given geographic area means upward pressure on demand for goods, services, and most of all, living space for that same geographic area. As we look at the boxes, the colored boxes on the right, we try to answer that question of whether this particular city, Phoenix being the example, is one of those growing in population. So we have statistics. U.S. Census Bureau says Phoenix ranks number one in the U.S. for fastest growing city. Affordability standpoint, we see that the Phoenix metro area is currently 3.3% below the U.S. national average as far as cost of living goes. And number three, income tax. The state of Arizona has a 2.5% flat state income tax that is currently in effect. So of all states that have an income tax, they are one of the lowest, if not the lowest, and they have very good property taxes to offset that as well. So a very financially desirable state to move into, still affordable, which is going to promote that in-migration of people. From a job diversity standpoint, right? We want to make sure that there's not just one big employer in town, or there's not just one dominant industry in that particular city or area, but we want to make sure that there's multiple jobs and employers in there, right? So if we look at the employment profile of the city of Phoenix, the Phoenix MSA, we can see that across industries, there's a very balanced, diverse group of industries that employers and employees are working across, which means if one industry goes down, whether it's due to something crazy like COVID or whatever other reason, we look at cities like San Francisco right now that are going, a lot of them, maybe 50% of them work in the tech industry, and we see 10 to 15% layoffs in that. You may not want to be an apartment owner in a city that's very one-dimensional from a job diversity standpoint when you're relying on those people to be paying, occupying your units and paying your rent. And lastly, is the location desirable, right? So is the specific location of this building close to shopping areas, grocery stores? Is it convenient to get to with major roadways and highways? Because that's what people look for when they're looking for a desirable location. And the last thing, and possibly the most important one, is evaluating the sponsor team themselves. All right. So the questions that we want to answer about this team are, what is their track record? How have they done on other deals in this particular market? What values does this operating team have as they're operating their business? And is their why aligned with what they're doing and why they're operating this business aligned with our why, right? So as we take a look at the current screen here, we're looking at a track record. And what we want to see when we're looking at a track record of a sponsor team is we want to see a theme of under-promising and over-delivering. Because as we take a look at the example right here, we see in the middle highlighted in red, we have the projected, these are the originally projected performance metrics of these particular deals that they gave to investors before they invested in these deals. And what we see are most projections you see at the very bottom under the IRR category. That simply means the compound annual rate of return that you get on your money over time. And so they were projecting a 15% annualized compound rate of return. And they were also projecting that you should anticipate holding your money for 5 years, 60 months. Now, you can look to the right and see how they actually fared on these deals. Now, they started purchasing these properties back in 2019 as things started moving in a positive direction. But you can see the actual IRR, the compound annual rate of return, averaged 70.8% on these deals, and their hold time averaged 18 months, a year and a half. Now, that's a ridiculous amount of returns to make in such a short period of time, and there were very many real estate tailwinds since COVID that helped facilitate towards that. But what's really stands out to me on this is these are 11 different deals that this team did over the course of many months throughout 2019, 20, 2021 that they've closed out on. And you can see on the last deal, right, the projected returns and the holding times did not vary that much all the way through this period that they were killing it, right? So we see that no matter what, this team kept their commitment to underwriting conservatively, even though they know they were overachieving. They didn't change what they were doing. So a great track record from a numbers perspective. Next thing we want to look at is, have they done other deals in this market? So as we look at the screen here, we see this particular sponsor team in this city. The dark blue icons indicate sold properties that they've already bought and successfully sold and exited. The light blue icons indicate assets that are currently active and under their management that they're working their business plans on. The red dot on this map represents the potential property that we might be investing in if we like this deal. And then you can see the yellow dot off to the right that shows the actual sponsor team's office building, showing they are nearby, they are local, and they are monitoring this market, and they are familiar with it. So, you see a lot of dots around an area like this, and it tells me that this is not this team's first rodeo. This team knows what they're doing. They're very experienced. They've built relationships around the real estate area around there with brokers and lenders and whatnot. And so I have confidence that this next deal is not going to be something that this team is navigating through for the very first time, which gives me confidence. And lastly, and finally, probably most importantly, we want to understand who are these people that we're giving our hard-earned money to, right? These deals, whether it's $25,000 or $50,000 that we're investing, it may take us a long time to earn that kind of money. So we want to understand who these people are that are going to be entrusted in stewarding our money. So the questions we want to ask is, what values do they operate their business with, right? And is their why aligned with our why? Who are these people and how do they conduct themselves, both as people and from a business standpoint? So Kurt and I, we may know them, Gibson Capital may know them, and yes, we've pre-vetted the individuals and the deals. That's why we're bringing them to our investor club. But don't be shy to set up a call directly with them yourself, right? The CEOs and sponsor teams of any deal that we partner on are fully accessible to any investors or even potential investors 5 to 7 days a week to chat and answer any questions you have. If you just want to get to know them, they're happy to do that. Very much unlike public companies like we invest typically with. So as we start wrapping up here, I want to touch on diversification. And multifamily real estate investing as an asset class, I believe is not being talked about enough, in my own opinion. And likely it's because Wall Street doesn't make any money off of it through commissions, if they were, but from any retail investors. So they probably just want to push their own products. Now, in my personal opinion, like I said, I believe our retirement portfolios currently are extremely one-dimensional. So the traditional 60-40, 80-20 investment mix and balancing between stocks and bonds that have typically been recommended by financial professionals over the past 3 years, I think has failed us pretty bad. Why? Because we aren't truly as diversified as we thought we were, right? Financial professionals have told us that stocks and bonds have an inverse relationship and you can hedge by having a mix of both. But in the current inflationary recession we've been in since COVID has proven that this is not always the case. And many late-stage workers and retirees have learned this the hard way, thinking that there's nowhere that they could put their money to be safe, with stocks and bonds both getting clobbered since 2021. Or at least they didn't think they had anywhere else to hide. So what I want to do is just take a quick glance here at the screen where we see an asset class performance comparison between the time period of Q1 to Q3 of 2022. And the reason I picked this time frame is because this is roughly the most recent stock market peak to trough time frame, right? This is where most stock markets peaked were at their highs compared to where they met their recent lows. And the point I want to make by choosing this time period, at least on this screen, is any asset can float upwards when the tide is rising and good times are rolling. But the best assessment of a quality asset is measured during testing times. So as we look at the numbers here, we see the NASDAQ, which is all the technology sector in the public stock market, between that time period was down 32%. Long-term treasury bonds, which have been hailed as the safe haven of financial markets, were down 30%. And then as we move over to multifamily real estate, you see the number there, but I want to talk about a few numbers behind the scenes that are not seen that are attributed to the number you're seeing there. And with multifamily real estate during that time frame, we saw rent growth remain very strong, climbing 10.7% year over year. The vacancy rate in multifamily dropped to 4.4%, reaching a new 5-year low. And so multifamily investment activity remained very strong during this time period, as we saw nearly $240 billion in sales flow into this specific asset class. Why? Because many of the people investing in this asset class during that time realized what we know right now, which is that large multifamily properties, talking about the 100+ unit count and above, a quality property could drop as low as 50 to 65% occupancy at times and still be breaking even on costs. You take single family properties, duplexes, triplexes, etc., and losing even one renter, and you, the owner, are stuck paying a large mortgage still, and you're facing a big financial burden. So even you look at a quality business like Costco, and I were to think if they were to lose 35 to 50% of their customer base for a prolonged period of time, I even find a quality company like that may have a hard time paying their bills. So these recession-resistant traits during this recent market downturn ultimately led to, in the multifamily asset class, cap rates, which is essentially the PE ratio of a multifamily asset, or how we measure real estate prices and valuations, in 2022 remained at historic lows, averaging 4.6%, down slightly from 4.9% in 2021, and thus leading to the number on the screen. According to the RCA CPPI Apartment Index, it posted a 15.9% annual pace of price growth in that same period of economic turmoil and in the financial markets. So from a protection standpoint and a recession-resistant standpoint, we see the power of specific asset classes in real estate, not all. Like Kurt mentioned, we focus on very recession-resistant asset classes. And so I want to close out here in looking at, we saw how multifamily can protect your money in downtimes. What we look to do, as we look at this slide, we want to focus on, well, what kind of returns can I expect over the long term? Now, the track record we showed of that particular sponsor team a couple slides ago showed some astronomical returns, like 70+%. But what they were projecting in the two shareholders, or two potential investors in those deals, was roughly around a 15% compound rate of return over a 5-year hold period. And so looking at this slide, we see a bunch of different numbers that you're going to see in these sample deals that are brought to you. The main thing I want you to focus on, though, is, at least starting out, is the equity multiple. The equity multiple you see in this particular screen is 2.13. And what this means, all this means is, if you hand me $100,000, the equity multiple tells you how many times your money you expect upon exiting this deal, right? So an equity multiple of 2.13 says this $100,000 investment over the 5-year hold period expects to equate to $213,000 at the end of the 5-year hold period. So essentially, you'll be doubling your money per projections in 5 years. And that equates, doubling your money in 5 years equates to a 15% compound annual rate of return. And so when Kurt and I vet deals, that's the minimum that we're looking to achieve. And those are really the deals that we pre-vet and bring to our investors. All right. So we'll leave it for some Q&A.
Yeah, so we'll go to Q&A. We only have about 3 or so minutes left, but if anybody has any questions or maybe feel free to type it in the chat or just open up your line. But maybe Chris, I think one thing that I'm curious about is one thing I didn't mention earlier is people have asked about the minimum investment, and generally the minimum investment is 50,000. So kind of when you're investing in these deals, having a significant amount, 50K or more, as an accredited investor is extremely important. Generally, those lower amounts won't get you into the deal. So that's generally the minimum amount for investing. And Chris, maybe one thing you can touch on before we closed, if somebody doesn't have available capital now, is there a way that they can invest? Kind of thinking from their, 401ks or other places.
Yeah, so this is a really big question because, like Kurt said, whether the minimum is 25,000 or 50,000, to get into these types of deals, a lot of us are saying, well, I don't have that liquid cash just sitting in my checking account. So the best part about this, when I mentioned a diversification strategy for our retirement portfolios, you can use retirement money to invest in these types of deals. And that's the best part about it, is we view these as long-term investments, right? With a 3 to 7 year time holding period for time horizon. So why not utilize our long-term, investment accounts and retirement portfolios? You can use an old 401k and roll that into what's called a self-directed IRA that lets you invest in alternative assets like real estate. And using an IRA, you can roll that into a self-directed IRA to invest in, like I said, in alternative assets like real estate. So you don't have to have all this money laying around. You can make it a part of your retirement account strategy as you build wealth over time.
Awesome. I'm not seeing any questions in the chat, so we'll just give it another second. But if there's any questions that come in, we'll note them. But as we close out here, I guess just a couple things to mention is, one, we're not in sales. We're not trying to sell you. There's none of that occurring here. This is purely informative. We're trying to educate you on real estate syndication. And from the folks that we've talked to, from our own investments, we've had success, and we want to share that with you. So if you have questions, this is our email here. Feel free to email us, call us, and set up some time. We're happy to talk with you more and share with you a little bit more about Gibson Capital, what we do.